You must abandon every single preconceived notion regarding traditional economic patterns, because at precisely 9:30 this morning, monetary physics fundamentally ceased to function. While corporate news outlets mask reality using terms like price swings, our current analytics verify a total outlier occurrence. This is a statistical impossibility so rare that it should not manifest more than once every 500 million years. The markets did not merely fluctuate today, they actually shattered into a million pieces. For 24 months, the central bank concealed their massive failures behind a $2 trillion liquidity reservoir known as the overnight reverse repo. This was the mechanical dampener preventing your reality from feeling the impact of a failing reserve currency. Now, you need to understand that, as of this morning's opening bell, the reservoir is completely empty. The balance is zero. The safety net has vanished. The internal wiring of the international monetary framework is now bone dry. Simultaneously, an $850 billion financial projectile launched from the east has hit its mark. This is not just a discussion about $100 silver or $5,000 gold valuations. It is a forensic examination of a dying currency. If you look at the macro view of the global circuit board, it is sparking and failing. While novice speculators obsess over short-term charts, the central bank in Beijing is conducting a sophisticated divestment through European intermediaries, diverting Western capital into primary physical collateral. They are not merely offloading our sovereign debt, they are purchasing the emergency exits and locking them from the outside. If you possess digital IOUs, paper contracts, or the belief that central planners will rescue you, you are the target. You represent the exit liquidity for institutional lenders currently submerged under $720 billion of losses. In a dry system, sovereignty is the only metric of survival. This is a fact you must accept. Today, we look past the sensationalism. We are accessing the core programming of this massive decoupling to reveal why February 27th is the definitive date for your financial endurance. Welcome to the forensic study of the fiat illusion. Things become truly fascinating here because the current reality is far deeper than most citizens grasp. Have you observed something bizarre regarding property costs or loan applications lately? Housing finance rates are acting in ways that contradict every established rule of interest rate behavior. The authorities have signaled coming reductions. Professional speculators have already factored in cheaper borrowing. If you look closely at the 30-year mortgage chart, the trend is terrifying. Yet, the typical 30-year fixed loan in this country just climbed to 9.15%. According to the most recent industry surveys, this is unprecedented. Let us contextualize this for you. When the central bank raises the base rate, borrowing costs usually climb. When they signal a decrease, those costs usually retreat. That is basic finance. It is a correlation that has remained consistent for decades. Yet, right now, we are witnessing a phenomenon that is mathematically illogical under standard conditions. The benchmark rate remains at 4.5%, yet mortgages are priced at nearly double that threshold. The 10-year yield, which traditionally dictates housing prices, has surged to heights not seen since the Great Recession, and it is decoupling from official policy for the first time in the modern era. You can almost hear the low rumble of the system failing. Picture trying to sell your residence, but every realtor in the region suddenly locked their doors. You would still hold the title. The asset would possess theoretical value, but there's no longer a tool to swap that property for liquid cash at an honest price. Consider the following reality. We have plunged into what professionals term a liquidity precipice. Valuations are collapsing not because the bonds are worthless, but because there are no longer enough buyers to soak up the flood of sellers. Consider this potential outcome. You intend to retire within 5 years, following the advice to maintain a split between equities and fixed income. Bonds are supposed to be the stabilizer, the defensive wall during equity volatility. But what occurs when the most secure asset on earth, U.S. Treasuries, fails to find a buyer at a functional price? Your investment fund does not just dip. It undergoes a total revaluation event where 40 years of perceived security vanishes in weeks. The Global Bank for Settlements noted extreme friction in what they term the financial plumbing. This is diplomatic phrasing for the pipes bursting. But there is a more peculiar synchronicity that most observers are missing. Quick question. What is the result when you mix a bond market drought with mortgage costs that have detached from their foundations? The answer manifests in the commodities sector. This is where the data becomes truly strange. The currency index is climbing at the same time that silver valuations are exploding. According to exchange data, this twin movement has only occurred 3 times in a century, and every time it signaled a total overhaul of the global order. Scholars call this a death spiral of trust because it shows investors are fleeing into the strongest currency while simultaneously rushing into hard physical assets. Here is what this means for you. Let us translate this into your daily life. When the currency strengthens, imported products should become cheaper. Your foreign travel should be more affordable. But when precious metals also climb, it indicates that smart money is betting that currency strength is a mirage, an illusion where everyone else is failing slightly faster than we are. They are acquiring metal as a shield against the moment our lead evaporates. It is like being the tallest passenger on a sinking vessel. Think about that for a moment. Yes, you stay dry longer, but the ship is still going down. The calculation here is actually quite simple once you view the underlying engine. According to official funding documents, the government must issue roughly $300 billion in new obligations every month just to keep the lights on. That is completely separate from rolling over old debt. Who usually buys this? Foreign banks, local lenders, and retirement savers. But here's the crisis. Foreigners are selling, local banks are underwater, savings funds just lost their best parking spot. And you, the individual, are watching your current holdings bleed value, wondering why you should buy more. This is what experts call demand destruction. We must sell the debt, but the natural audience has vanished permanently. Now ask yourself why this is happening. The repo facility reaching zero is not just a chart point. It is the warning signal that the environment has become lethal for those who keep the system moving. Why is this not the main headline on every screen? Why has your advisor not called you? The answer is uncomfortable. Most of the industry functions on the assumption of normalcy. They build projections based on half-century trends. When those trends break, they do not panic. They assume it is a temporary glitch. They are trained to bet on things returning to the middle. But when the numbers get this extreme, statisticians stop adjusting models and start questioning the fundamental reality. The core assumption currently shattering is that there will always be a buyer for our debt. That belief lasted 80 years. Today, it is breaking, and the shockwaves are moving faster than you realize. Let me show you how this sell-off is actually being conducted. The method is more revealing than the act. When leaders discuss foreign ownership of debt, they cite monthly reports. But those reports only show where bonds are stored, not who owns them. If you wanted to dump a massive amount of debt without causing a global panic, you would not do it in your own name. You would move it through financial hubs where it looks like normal trading volume. If you look at the maps of Brussels and Luxembourg, you see the epicenter. Last week's data showed this exact pattern. Tiny nations like Belgium and Luxembourg are showing swings of $70 billion in debt holdings. Does that seem logical? These are not economic giants. They are custodial hubs where central banks can trade without leaving prints. When we sync this with international settlement data, the truth is obvious. Direct holdings are stable, but the hidden liquidation through these proxies is running at $50 billion per month. Imagine you own a business and the major partner starts selling out. But they do it through offshore accounts, so it does not show up on the registry until it is too late. By the time you find out, the value is gone and you are left holding the bag. Think about your future. That is our current bond market. Your retirement account likely holds these very assets. Have you checked your exposure lately? According to industry data, Americans hold $7 trillion in bond funds. A huge portion of that is backed by government debt. When the buyers vanish and the sellers are dumping $50 billion a month in secret, the math is fixed. Prices must crash. Yields must skyrocket. Every safe portfolio is being hollowed out. But the bond crisis is only one pillar. We must look at the banks. Let us look at the banking sector, where liquidity is turning into a solvency nightmare. The FDIC's latest profile shows $720 billion in unrealized losses. Think about that. Your local branch, your mortgage holder, they are sitting on nearly $1 trillion in losses they have not admitted yet. How? Accounting tricks allow them to label bonds as held to maturity. If they pretend they will never sell, they do not have to report the loss. But those bonds are still the collateral for your checking account. Every time rates go up, that protection erodes. For every 10-point move in yields, another $12 billion in losses is created. The 10-year has moved 80 points recently. That is nearly $100 billion in new losses in just a few months. Do you feel safe? You might think your bank is fine because the sign is still up. But failures do not happen slowly. They happen all at once. Silicon Valley Bank looked great until the moment people asked for their cash. They had $40 billion in hidden losses. When they had to sell to pay depositors, they died in a single weekend. There are 4,000 banks in this country. How many are one phone call away from the same cliff? We will not know until the doors lock because the rules allow them to lie until the end. We need to shift our focus now. Let us pivot to something physical that cannot be faked. Let us talk silver and the futures exchange. The Comex is where the world's metal prices are set. It is supposed to be for hedging, but there's a category called registered silver available for actual delivery. That inventory has plummeted to 28 million ounces. Meanwhile, the paper claims against that silver represent over 500 million ounces. That is a ratio of 18 people claiming the same ounce. Some metrics say it is as high as 300 to 1 when you add derivatives. Imagine the chaos of that realization. What happens when a few of those people actually want their metal? The system breaks. We saw this in the nickel market. They literally canceled trades to save the banks. If you own silver through a digital fund or a bank statement, you do not own silver. You own a promise. In a crisis, they will settle that promise in dollars at a price they choose. Their rulebook says they can do this. If even 5% of holders ask for physical delivery, the game is finished. The exchange will declare a force majeure and pay you in devalued cash, while the real metal price goes to the moon. Here is the supply reality. Global production is only 1 billion ounces a year. Half of that is used in industry. Investment demand is exploding. You cannot have infinite paper claims on a finite physical metal. The question is, when the reckoning comes on February 27th, will you have the metal or the paper? The people dumping debt in Luxembourg are buying physical. They are not buying ETFs. They are taking delivery. You must act accordingly. The paper system is on borrowed time and the clock just stopped. There is no policy that fixes this. The math is now the enemy. We are now adding 1.2 trillion in new debt every 100 days just to pay the interest on what we already owe. That is not for roads or schools. That is just the cost of borrowing. Our debt is 36 trillion at 4%. We are paying 17 billion a month in interest. To pay that, we borrow more. It is a debt trap. There are only two exits, default or inflation. Consider the history of currency. Governments always choose inflation. It is a hidden tax on your savings. It destroys the social contract. When $20 barely buys bread, people look for real money. This is where the gold to silver ratio matters. Historically, it is 60 to 1, but silver is only 15 times more common in the earth. Above ground, it is 8 to 1 because silver is used up in industry. So why is it priced so low? The paper suppression we just discussed. In a crisis, that ratio collapses. In 1980, it hit 16 to 1. If gold is $5,000, a 40 to 1 ratio puts silver at 125. But gold itself is cheap. Compared to the money supply. Fair value is north of $5,500. At a 40 to 1 ratio, silver is nearly $140. And that is just the baseline. In a short squeeze where people demand physical, it could hit 200 or 300. Does that sound impossible? In 1979, silver went from $6 to $50 in months. That is an 800% move. We have all the same ingredients today, but with more leverage. Silver has been climbing quietly, breaking $32 while everyone was looking at the stock market. Premiums on physical coins are already rising. Pay attention to the physical market. The market is telling you the paper price is a lie. This brings us to February 27th. That is the first notice day for the March silver contract. This is when people must decide, do I want the cash or the metal? Usually everyone takes the cash, but if even 10% want the metal, the exchange is empty. They either drain the vault and start a panic, or they admit they have no metal. Either way, the suppression ends. The physical price will detach from the paper screen. Your wealth on February 28th depends on which side of that line you are on. Here is the endgame. The authorities are not blind. They see this coming. Their plan involves capital controls and digital currencies. The tech is ready. They just need a big enough crisis to launch it. Controls mean you cannot move your money out of the dollar. They mean limits on buying metal. They mean trapping you while your value is inflated away. This is why the window is closing. Waiting until the news reports it is waiting too long. By the time the exit is obvious, the door will be locked. A ticking clock is all that remains. This is not about fear. It is about the new rules. The strategies of the last 40 years are dead. Real wealth is not a digit. It is a tangible asset. To those who think they can trade this, listen closely. To those who think they can trade this, you cannot trade a system with no plumbing. When the repo hit 0 today, the floor fell out. Now, if you are playing with leverage, you are just providing liquidity for failing banks. In this environment, profit is secondary. Sovereignty is everything. The difference between being wealthy and being secure is now clear. One is measured in paper, the other in reality. This is the truth of our time. This is the forensic report on the dollar. We have identified the cause of collapse, the hidden selling, the bank losses, the silver squeeze, and the debt spiral. Every data point leads to the same end. The paper era is over. The coming years will favor those who knew the difference between a promise and a property. The decision is yours, but the time to make it is measured in weeks. Please hit the like button and subscribe for more updates here at Commodity Advisor. We are entering the final stage of the grand divorce. Make sure you are positioned for what comes next. This is the final warning. Because when the system goes dark, only what you hold in your hand will matter. Thank you for watching. Our journey together into the truth of the markets continues in the next video. Stay safe and stay physical.